Okay, good morning, everybody, and welcome to the Daily Energy Markets Forum webinar, the last one of 2020. It's been an amazing 9 months since we kicked off this session, and each morning we take a reflection of where the market has opened in Asia, and we're joined by regular commentator Omar Najia, Global Head of Derivatives at BB Energy. Omar, it's somewhat appropriate that we finished the year with oil prices getting back to the highest level since the pandemic kicked off.
Yeah, morning. So yes, higher prices across the board, be it basically from the S&P to Bitcoin to oil to, a lot of stuff basically. I think yesterday we saw Bitcoin go over 20,000. I think that validates the view of a lot of people going forward. So again, it's a proxy for risk taking, I believe. So that's a positive sign. It's at 21,000 now. I think it goes considerably higher. I also think that the dollar has actually found its low. So I'm now extremely bullish the US dollar. I think the low was yesterday. If I'm wrong only by a few days, I believe. And I think oil prices, like I've been saying, trek from here to about 50 and a half, something like that, before we correct. But the trend in oil is up. The S&P first target 3785, longer term targets like 4600, so also up. Euro lower, GBP lower, considerably so over time. Gold, I think, I'm not a fan. So yes, risk on, East versus West, anything to do with commodities, anything to do with China, anything to do with emerging markets, and less to do with the Amazon and the Apples and all this stuff basically that's been leading the way, because I think those are not done and dusted, but I think, they've seen massive growth. Now you've got to see basically if their earnings actually justify the price levels which they're at.
I suppose the return of the real economy, maybe real demand, rather than the home bedroom economy of the crisis. We're joined on our last day of the year by Philip Vahn, Senior Managing Editor, S&P Global Platts, sitting in Singapore. Philip, one of the notable stories of the year, I think, is a little bit about what's the appetite. And clearly Asia loves the crude oil, that all of it can get as cheap as possible. But does it love American oil more than it loves Middle East oil these days? How do you see those two facing off, if you like, going into 2021?
Hello there, Sean. Good afternoon from Singapore here. That's a very interesting question. Obviously, Asia's appetite for crude, it's just never limited to Middle Eastern crude oil. You've seen recent years, they've been massively picking up US oil, not just US oil, West African oil, North Sea crude as well. So basically, the major Asian crude importers, just look at China, South Korea, Japan, for example, they've made rigorous efforts to diversify their crude import sources over the past several years, of course. But typically, refiners in China, South Korea, and Japan, they rely heavily on Middle Eastern crude up until several years ago. Just give you some percentages. Middle Eastern crude that made up more than 90% of South Korea and Japan's total refinery feedstock import basket, and it was more than 65% for China's case. But these big crude importers saw the need to diversify their crude import sources because of geopolitical jitters caused a bit of a supply disruption. If you remember those missile attacks on Saudi oil facilities, troubles around the Straits of Hormuz, all the economic sanctions on Iran, if you also remember a few years back, right? So Asia saw that need and the urgency, so they've started to raise their imports from producers outside the Middle East. US crude, as I said, US crude imports rose sharply from 2016 onwards, and Asia was also actively buying CPC blend from Kazakhstan, medium heavy grades from Mexico and South America, and so on. Now, but what's interesting is these major Northeast Asian refiners, now they've started to take a U-turn on crude import diversification strategy this year. They are poised to heavily favor Middle Eastern crude over other crude grades, at least throughout the first half next year. That's our projection. Now, this is because these companies, they see this, their staple Saudi crude as the most reliable and economical feedstock option in times of high market uncertainty. Now, just to give you an example, China for one, right? Several newly commissioned refineries over there, they are opt to process Middle Eastern crude oil primarily because most of the refinery systems in Northeast Asia, they're mainly configured to process medium and heavy sour crude oil, and that's what they're most comfortable with.
Well, they're certainly demonstrating, it seems, in the recent times, very high throughputs. China, India, back up to close to 100%.
That's right, especially China. They have this government margin, so no matter how much the oil prices, product prices fall, the government has a system where it keeps a product selling price within the domestic market. So when the crude oil prices, the feedstock prices are below $50, they have a guaranteed margin for them. So that's why they were actually, China was a standout importer of the crude oil in the recent past few quarters, right, despite the demand destruction. So that is somewhere that's been supporting the prices in a way, especially China's demand, wasn't it?
Let's go across to Michigan. A regular commentator, Dan Graeber, author of the GERM Report. Dan, once again, inventories have come back. At least this week, they're paying attention. Last week, they grew 15 million. Nobody said, that's nothing. This week, they dropped 3 million barrels, and the market took off on the back of it.
I've commented before that, people have made careers out of bashing data from the EIA and the API before. So I wonder if there's some adjustment factor going on, given, last week we saw a $15.2 million barrel build in U.S. crude oil inventories. We saw last week that, most products came down lower than expected. So we could see some demand moving back into the economy, but we still have to remember that this is, we're looking at things in relative capacity. Where are we at compared to last year? Inventories are still a little bloated relative to where we are last year. We've got a U.S. storm brewing in the Northeast that's supposed to dump about a foot of snow on some parts of the East Coast. So we'll see what those levels look like next week. Meanwhile, we have a lot of state governors, calling for, muted holiday celebrations, yet still, our levels here in Michigan for new infections are around 4,000, which is considerably less than it was about a month ago, but still, awfully high relative to where we were during the summer. So we're not quite out of the woods yet. We saw vaccines roll out of Michigan facilities earlier this week. That's a promising development, giving people reason enough to move into some riskier assets. But I'm seeing reports today that they're having distribution problems with the cold storage for the Pfizer vaccine. So maybe we got a little too ahead of ourselves. I was speaking with folks last week at Platts on their year-end outlook. And their sentiment was that, fundamentals don't necessarily support $50 Brent. So, we could be due for a correction come the first quarter.
It's certainly if you echo the sentiment, I would say, by Chairman Powell yesterday, the Federal Reserve Bank chairman speaking yesterday, got a lot of headlines. Generally, the tone was, I'm going to keep printing as much money as I can because this economy still looks quite fragile.
It does look fragile still. The big bet on crude this morning seems to be optimism on overpassing a U.S. stimulus package. That's talking about putting, smaller checks than we had last time in everybody's bank accounts, supplementing, unemployment insurance levels a little bit. But, that really doesn't do anything for the here and now. So I think, looking at the Fed statements, they're spot on to say we're going to need to be supportive at least through the second half of next year, which seems to be the consensus.
He's going to keep being supportive until we see full employment, which could be quite a long time. Omar Najia, back to you on that point. You're calling the bottom of the dollar, and yet you've got a federal chairman who just wants to keep on printing. How do those two things go together?
Well, I've tried to explain many times, and I'm about to basically throw myself out the window, but they don't actually print dollars. So they don't print dollars.
Well, okay, a figure of speech. The guy is
Yeah,
willing to buy
but
every
this is why.
bond. He's willing to
Yeah,
buy every
yes.
bond you're willing to sell,
But
junk or
again,
otherwise.
this is why people assume that they're printing, and therefore there's inflation, and therefore the dollar weakens. It doesn't happen that way. So there is no inflation. So again, people or the market or the Fed, they buy Apple as a company. They don't buy the iPhone. They don't buy the products. There is no inflation. That's one. Secondly, they don't print the dollars exactly like you say. They buy the bonds, they buy the ETFs, they buy whatever. So they print debt, not dollars. So I think basically that the US dollar, if you look at the US dollar, it's been falling for a huge amount of time. The second thing I would caution is everybody and his dog is bearish the US dollar. Everybody. When things get this extended in time and price, and basically, when everybody's one way on a trade, all it takes is just a little bit of a spark. And when you get that, you're going to see people rushing to the exits. For example, that happened yesterday. I was watching Bitcoin. Bitcoin was trading massive volumes, 19,500. It got up to like 19,900. Massive buying, massive selling. And all of a sudden, it just broke. And when it breaks, the people head for the exits. The people selling legged it. And when they legged it, the market went from about 1950 to 2150, okay, which is a massive move. So again, I think people are too much one way on this trade, and it's too crowded a trade, and they're going to head for the exits. They've been on this trade for a long time. They've made a lot of money. When they close out their positions, that's what's going to be basically the initial push to the upside. And again, it's not a US, and the Fed can't do anything else. They don't have any other tools except, buying these things, making, printing debt, making debt cheaper, keeping interest rates cheaper, but they are not able
Well, in
to
some
help.
ways, it feels like a race to the bottom, because obviously the euro and others will be looking to try and weaken their currencies too, given the scale of how much the dollar has fallen. Let's go back to Philip in Asia. Philip, one of the things we've seen over this cycle has been the incredibly thin refining margins that refiners all over the world had to struggle with, including in Asia. Have all survived this? Is it still with us? What's your outlook for the impact of thin margins in refining in Asia?
Okay, it's been really a cycle of survival for Asian refiners here, obviously. Volatile prices, volatile margins.
Philip, may I just suggest you turn off your camera, because your bandwidth seems to me a little bit struggling, and so your audio might be just better by itself.
Okay, now how's that sound?
That sounds better, yeah.
Better. Okay, yeah. All right, just continuing on really. The survival of the refiners this year. Okay, I can at least tell you that major Asia, the state-run ones and the big conglomerate ones, they're doing okay. For example, India's IOC, China's Sinopec, China, Thailand PTT. These are companies that have that strong state backing, right? And also South Korea's SK Innovation, Japan INEOS. They are part of the big conglomerate with ample cash reserves too. So the big ones are doing okay. They're surviving through. But it's the small and medium-sized refiners, especially the Philippines and Australia, they've been hit hard this year. Oh my God. Just to name a few, Philippines, the Pangal refinery, they announced they'll permanently shut and transform the facility into oil import terminal. Australian refineries, oh my God, they've been the biggest victims of poor refining margins, domestic demand destruction, volatile prices we've seen. Geelong refinery, Lytton refinery in the state of Queensland, announced closures. Geelong, they're actually mulling closure soon enough, following reporting a $100 million loss in the first half. Now, what's interesting is that now this is actually a good news to major fuel producers in Asia, like India, China, and South Korean refiners. They actually have been struggling to export and sell oil products this year, obviously due to tepid transportation fuel demand across the region. But the Philippines and Australia, they've completely lost their ability to produce their own fuel. they had no other option but to buy more gasoline, diesel, and jet fuel from South Korea and India and China. So it's pretty much your pain is my gain kind of thing in the Asian oil products market.
Thank you. Dan, your former governor, Governor Granholm, if I pronounced her name correctly, has been selected or will be selected as the next U.S. Energy Secretary. I wonder what you can tell us about her and what does her appointment sort of signal for her and her leadership of the energy sector?
Well, Granholm was popular for one of her terms, but then, she served 2 terms as a governor. Much of that was during the Great Recession here in the U.S. states. She has a good relationship with the automotive industry, which will be good to roll out any, new electric vehicle initiatives under the Biden administration. That could be an engine of growth. We're already seeing some of the bigger motor companies here, the big 3, kind of retooling to get on that EV bandwagon. During her tenure, she passed, renewable energy standards, mandating the state will get 10% of its energy from renewables by 2015 and 25% by 2025. Here in Michigan, there is a considerable wind energy regime. If I ask somebody where they live in Michigan, they'll hold up their hand. So in the thumb area near Canada, there's a lot of wind energy. My wife lives in the Detroit area, so when we travel back and forth, it's a lot of farm country. So it's interesting to see. And every time we make the trip, it seems like there's a new solar farm popping up. So she might be the one to kind of lead that initiative. She might draw on that Midwest appeal that put Biden in the White House as well. But we might see some kickback given her tenure. From Republicans wary about that sort of initiative. We could look at things like the failure of Solyndra as a case in point where, the Republican Party might have some kickback on that to say it's too much too soon and shale isn't quite over with yet. But all in all, it looks like, a routine pick from the incoming Biden.
I mean, I've always liked her as a politician. She's got sort of guts. She's strong.
Yeah, she does.
She's clear in her communication style, which I think is useful. Some of the former energy secretaries of recent times, even Moniz that we had under Obama, very academic guy, not a lot of charm.
She can control a room, that's for sure. Not to show my cards too much, but my family's got pretty strong labor ties here in Michigan and ties to the Democratic Party. So I had the opportunity to see her speak several times, and she can put a room in the palm of her hand. And somebody like me who's a little bit more laid back, even though I felt the excitement of the room, she certainly brings with her a buzz in the room. She carries herself with a great deal of confidence. She's a table pounder on her, and she knows how to get things done. So she could be the good pick to help push us over the edge.
She wouldn't be cowed by Prince Abdulaziz in Saudi Arabia or Novak in Russia. So it'd be interesting dynamic to see those 3 if they ever ended up in a meeting room.
She can certainly hold her own, that's for sure.
Yeah, that's what I thought. Omar, holding your own and the new year that's upon us, oil prices on the move, clearly, as you've signaled. What are the likelihood, do you think, that excess supply spoils the party coming from whether it be shale or whether it be our friends in OPEC loosening up a little bit? What's your outlook for excess supply coming into the market in the new year?
Look, I think basically with that kind of stuff, you can never tell. What I can tell you though is, I mean, with OPEC, who knows? But what I can tell you is shale. I know yesterday they were talking about, shale. Whatever shale is for me absolutely done and dusted and finished, as is U.S. energy dominance, as is, that's all gone. Shale's big idea, basically, people talk about, or yesterday they were talking about technological innovation. There's nothing to do with anything. Shale, you inject stuff into the ground, you break up the rock, you suck up the oil. That's it. The technical innovation is called sand. There was actually quite a few reports on Bloomberg and Reuters and whatever about, how people were being fooled with this technological innovation stuff. But bottom line is, nobody will lend any more money to shale. All their shares are, down the toilet. Their debt is massive. You're not even seeing consolidation. So no company's buying the other company because none of them can make money ever. even if the price of oil goes to a gazillion, because they have a gazillion worth of debt to pay. Shale's idea was always invest.
Well, they wouldn't be alone in owing gazillions. I mean, we even have to invent new phrases, because trillion just doesn't do it anymore.
Very true, but I think people will want to lend to others, to other companies, to other whatever, to themselves rather than to shale. Shale will over time, I don't know if disappear is the right word, but weaken. So there's no more growth, in other words, that you're going to see from shale.
Andy Lave's been saying in the chat room, your protagonist in the chat room, that they'll write off the shale debt.
Yeah, maybe, and turn into unicorns, grow wings, and fly. Also possible, but improbable.
Well, I think inevitably there's going to have to be a lot of debt write-off and all of this, because student loans and God knows what. Otherwise, you're going to have to tax people beyond the unknown. Let's go to the survey question before we go around the speakers to get some sense of their outlook for the year ahead. Which of the following offers biggest threat to oversupply in the oil markets next year? OPEC plus compliance dropping off. Iran returns to the market because of the JPCOA. We have a story on our digest today where the Iranian president is signaling that he has authority to engage with the Biden administration. Or shale is back, contrary to what Omar has just said. Lots of shale can come back, perhaps. So which of one of the following offers the biggest threat to oversupply in the oil markets next year? All of the above is not an option, I'm afraid. So pick your poison, and we'll go around the table to get our panelists' views about what are the big stories to watch out for next year. So Philip, tell us a little bit about Asia next year. What is your expectation? Will China continue to be the engine of demand growth in 2021 and lead the world to higher oil prices?
Okay, it's always exciting to talk about oil prices. And from our perspective, we believe the sustainability of the recent oil price uptrend will depend a lot on the demand side fundamentals, especially Asian demand. Yeah. Well, when it comes to demand, of course, we all know Asia is the center of the demand world, so that's where the key focus should be. Actually, a couple of bullish news for me to start off with. China is actually poised to go on a bit of a crude oil shopping spree in the early trading cycle next year. Now, this is because Ministry of Commerce, China, they expected to release first batch of 2021 import quotas for the country's private sector refiners next week, I think. Now, the private sector refiners in China, they need that official government permit and quota to import crude oil. And they normally seek to buy as much as possible in the early phase of the year to fully utilize that first round quota in a bid to increase chances of securing next round of quota as well. So that's something we can, hopefully see some bullishness into it. Now, fuel demand from the industrial manufacturing sector in Asia, it's been pretty stellar too lately, of course. For example, we've seen South Korea's exports of electronics, tech devices, automobiles in November up 4% year on year. China's manufactured goods exports in November, it was up 20% year on year. And that's thanks to global demand for all these remote working tech devices and gadgets, right? Now, but I had a meeting with a few refinery trading managers in Beijing, Seoul, Tokyo, Hong Kong recently, virtually, of course. What they believe is that Brent price rise from any rise from the $50 mark will be very short-lived for the time being. And the recent uptrend, it's not going to be really sustainable because fuel demand from the transportation sector remains very, very weak. Now, obviously, the airlines, the flights have been grounded. Air passenger numbers, still the monthly numbers are still 90% down year on year. Now, gasoline consumption too, across Asia, it's very, very weak, to be honest. Obviously, due to the prolonged movement restriction measures imposed across Asia as well. Just to give you a bit of forecast numbers from our own S&P Global Analytics team, we expect Brent prices to pull back now in the short term to the low $40 per barrel mark before creeping back up, rebounding towards the $50 mark again in late 2021.
Okay, thanks, Philip. Dan, your thoughts? Obviously, America finally getting to the other side of the presidential election mountain. Trump obviously isn't going away, but ultimately he will be leaving office. What's your big ticket items for 2021?
Well, you hit the nail on the head a bit. I think it's the Trump influence on politics moving forward. I watched a hearing yesterday on election interference, and we have Republicans and Democrats sniping over election fraud that doesn't exist. I'm looking at the runoff race in Georgia. They're crying foul already there. It looks like some of those tactics that Trump was able to use to push forward his narrative, to push forward his ideology, and to push forward his policy is still going to work for some of the Republicans. I mean, we're still seeing protests in the street with people saying Trump won, et cetera, et cetera. So I wonder how much of a ramification that's going to have on the incoming Biden administration. I'm also looking at, what does the new normal look like for the United States? We read the IEA report that said, jet fuel is going to account for like 80% of their demand cut for next year. Are people going to travel? Are people going to go to concerts? Are people going to go to a theater? And furthermore, are people even going to get vaccinated? We're seeing reports of allergic reactions to the Pfizer vaccine already. I've heard horror stories about the double dose shot that people might be reluctant to go back to get that second dose. So, a lot of it is going to depend on the ability of the Biden administration to stoke unity once again in the political culture. And it's going to require some moxie from the American people to get out again and spend money. So, I think it all depends on this vaccine rollout and the political climate moving forward.
Let's get the survey result before we give Omar the last word of the year, so to speak. Which of the following offers biggest threat to oversupply? OPEC plus compliance dropping off, just pips. Iran returns. Shale is back, is in the Omar Najia camp. Shale is not back. Well, 16% think it may be. Iran returns and OPEC plus compliance drops off. Of course, Iran is part of OPEC, so maybe that all goes together. How does OPEC plus accommodate the return of Iranian production? That might be a challenge all of its own. But Omar, your closing thoughts, some one or two headlines to watch out for next year.
Look, I think basically markets are moving in the right direction. So I really don't have any axe to grind. But what I would say, and forgive me for saying so, is that I absolutely adore something called Bitcoin, and I have for maybe 3 years plus. If you guys have like a small allocation, I'm not saying take loans out and buy Bitcoin and sell the house, but what I am saying is if you've got 10k, 5k, buy a quarter of a coin. If you got 10k, buy a half of a coin. 20k, buy a coin, and just leave it. If you can afford to lose that money, just buy it and leave it. Not buy it to trade it and buy it to whatever. Just buy it and hold it long term. Because I think yesterday's break of 19,980, the move about above 20k, really is really important for a lot of technical reasons, which are too boring to go into. But basically, it confirms that Bitcoin is in a major uptrend now. So if you
what was its previous high? What was its previous high before?
About 19,900 and something.
When was that? A year or 2 years ago, or when did it get there?
That was 2017, I think.
Right.
So basically, it went up from 0 to 19,900. It came off. And the fact that it basically went back above it means that the coming off period from 2017 to 2020, that is all corrective, because now we're above that high again. And that's a really important factor. It means that basically this rally should have, nothing is certain in life, but should have legs. And
but if you take them, go ahead. Yeah, sorry.
So it needs to basically move high enough above that previous high of, call it 20k, so that when the next low comes, it stays well above it. So therefore, you can look at this thing to really grow some not legs, but probably wings. So I like Bitcoin. Invest a tiny little bit, whatever you can, whatever.
But it's
and come
certainly,
back and let me know
when we were talking earlier, and I suppose that's the sort of punctuation point for the end of this season on the Gulf Intelligence Daily Energy Markets Forum. Debt, and more debt is upon the world. And without even being a sort of an analyst of Bitcoin, one would have to say, as the sovereign states pump and print and whatever way devalue the value of money to the extent that it makes sense on some very fundamental level that the new store of value would surface other than a paper dollar bill. But listen, before we wrap up this year, at the end of our season, I want to draw your attention. The next time we'll all be together is our forum on January 13th. We've got an amazing lineup for a really comprehensive outlook for the year ahead, starting in the early morning Asia time, or in Asia, Middle East, Europe, US. Irene will just flow through the agenda. But some great speakers, the CEO of Pertamina in Indonesia, the CEO of Petronas Downstream, Mike Muller, of course, known to everybody, CEO of Vitol Asia, the presidents of Rotary Group, a whole bunch of speakers across a number of round tables. In the Middle East, we've got the UAE energy minister. We've got the Nigerian CEO of the Nigeria National Oil Company. The Middle East, we also have the ADNOC new head of trading, ADNOC Trading. So we've got a whole bunch of stuff. Then into Europe, we've got the OMV CEO, we've got the Vitol CEO, we've got Christoph Ruhl interviewing the great Sir Mark Moody Stewart, the former chairman of Shell, who has great visions of the future of the low-cost producer, really useful insights from those two very, big thinkers in our industry. And then in the Americas, we finished the day with a feature interview with the OPEC Secretary General, as well as a national panel on the outlook for U.S. foreign policy under Biden. So it's an action-packed day, and Omar and Dan and all of our regular commentators will be participating. So just put it in your calendar, the 13th of January. But until then, Merry Christmas, Happy New Year, and we look forward to seeing everybody at the Outlook Forum, the virtual forum on January the 13th, whether it's on the Zoom room or you watch it on LinkedIn, all are welcome. Spread the word, tell your networks. We'd love to have everybody join. Comprehensive outlook for the year ahead on January the 13th. Thanks, Dan. Thanks, Philip. Thanks, Omar. Merry Christmas and a Happy New Year.
Thanks, Sean. Happy holidays.
Cheers.
Cheers.
Thank you, gentlemen.
Thank
Thank you so much.